Hi, good evening, everyone. This is Sahil Kapoor. I'm Head of Products and Market Strategy at DSP Mutual Fund. Today evening, there is a new session of Adding Zeros. This is our attempt to bring to you unfiltered insights into investment world. Today's topic is about how to create a portfolio, Zen-like portfolio, and specific focus is on passive investing. Uh, I have three very renowned guests from the industry today, and we are fortunate to have all three of them today. We are joined by Mr. Vivek Rege. He's the founder and CEO of VR Wealth Advisors Private Limited. He's been in the industry for a very long time. He's got over 20 years of experience. VR Wealth Advisors was one of the first companies, one of the first 30 companies in India to get a license from SEBI. Vivek is also the founding director of ARIA, which is Association of Registered Investment Advisors, security aid company, and he interacts regularly with SEBI on behalf of investment advisors community in India. And he's also newly elected board of ARIA, and currently he leads as chairperson of ARIA. I'm also joined by Mr. Santosh Navlani. Santosh is the CEO of ETMoney, a well-renowned face in the industry. And as you know, it is India's highest rated independent mutual fund app and also one of the fastest growing investment advisory platform in India. Prior to ETMoney, Santosh was senior vice president at DSP BlackRock, the erstwhile DSP BlackRock, which is now DSP Mutual Fund, where he's developed India's largest digital platform for agents and partners. And prior to joining DSP BlackRock, Santosh co-founded Money Sites, which made investors well informed. And he was also part of the which got acquired by Times Internet. And before fintech stint, Santosh was marketing and advertising professional with Inmobi, Perp, and Cartesian Consulting. So, welcome to both of you. And I'm also joined by Mr. Anil Ghelani, my colleague. Anil has been in the industry for over 2 decades. Currently, he leads the investment, passive investments and products vertical at DSP Mutual Fund. So, welcome to all of you, and looking forward to a great session. Anil, I'll go to you first to set the ground rules and talk about our topic today. So I read just about yesterday that passive AUM in US has overtaken active mutual fund AUM, which is I think a big change, and it has happened over the last 1.5 to 2 decades, a massive juggernaut for passives. So first question is, what is this change? Is this durable? Do you think this is going to continue in the future? And what are these passives? What is this new, sort of way of investing which has taken over the erstwhile stock picking and the traditional way of investing? Anil.
Super, great, Sahil, and thanks a lot for the wonderful backdrop. And wish you all a very warm welcome, friends, and a great welcome to both Vivek and Santosh. So kind of you, and thanks for being here. I'm very much looking forward to a very unique perspective and engaging chat with both of you. So Sahil, like you mentioned very correctly, like even we were observing the last month and that the passive total AUM in the US had outstripped the active AUM block of money for the first time. It's a big thing, basically. Now, why I believe this is a structural change and long-term in nature, because it is not suddenly overnight it has happened. Previous decade was the decade when gradual growth in passive happened. So 2013, 14, I still remember distinctly around that period, 13 or maybe 14, was the first time in the US markets when passive funds saw net new money inflows, which was slightly higher than the quantum of net new money inflow which went to active funds. So it was a little bit talk of the discussion in the marketplace कि अरे हाँ भाई active funds को relatively थोड़ा कम पैसा मिला, little bit lesser flow came into active than passive. Okay, understood. People were accepted that. Gradually over the next 5-7 years, it started growing such that then active funds were seeing net new inflow much more smaller, and last couple of years it has happened that in fact active funds saw net negative flows. Let's say during the 2 years, 3 years back pandemic crisis and the time beyond that, and passive funds were seeing net AUM block also now outstrip the AUM for the active funds. Now, friends, in India, I think we still have a long way to go for that. But in India, from last, if you must be tracking some data points, last 2-3 years, especially let's say in the large cap as a category, the fresh flows coming into that category of active funds has been a little bit slower as compared to, let's say, the large cap category in the index funds, ETFs category. Structurally, because of that, I believe that in India also, maybe gradually will come there. Long way to go yet. Today, we are approximately only 17% of the total mutual fund industry. Yes, it is quite a large number. Maybe if you would have been tracking about 4-5 years back, it was hardly 5-6%. So it has grown very fast. But I believe structurally what we have seen in the US markets, not always everything is replicated, but I very strongly feel that this trend of passive funds gaining a little bit more importance will soon be replicated in India market as well.
Sure. Thank you, Anil. Vivek, one very basic question to you so that all our viewers are abreast of what we are discussing. So, what basically are passive funds? Sometimes people ask us that an index is better than a mutual fund. What is the difference between a mutual fund, a passive fund like an index and ETF? If you can just simplify it for the viewers.
Yeah, sure. And thank you, Sahil, for a generous introduction today. So, see, it's very simple. So the difference is when we are looking at a passive, essentially you are buying a market. Okay, so when you talk about market, it is a Sensex, which is or a Nifty. Okay, that's an India market. I mean, all of us know that. So let's assume that we want to enter into a market, India market, then you look at a index, and that index is a Sensex or a Nifty. Now, when you are buying a market, that is passive because you are not selecting which part of the market you want to buy. You are just saying, I want to buy and take exposure into India market. And that is simply passive. Okay, right. So very, very simple. Point number two, passive, so there is an index. Okay, so what does passive mean? It is essentially an index, which is a Nifty and a Sensex. Now that has to be converted into a product.
Right.
Okay, that product is something which is called as an ETF. First, the product gets birth into a form of an ETF, which is known as an exchange traded fund. So it is traded on an exchange, on a Bombay Stock Exchange or a National Stock Exchange. Further to that, you package that ETF into something known as a fund. Okay, that is essentially a packaged product of a mutual fund. So the difference between the two is that ETF is traded on the exchange and mutual fund is something which is packaged together, right? You package an index and you put a mutual fund, saying that this is a Nifty 50 index. So that is primarily a basic difference, for us to understand.
So largely what you're saying is that a product which replicates the index of what the index constituents are, simply put, that is the passive fund. It can take any shape. It could be form of an index fund, which is a mutual fund. It could be an exchange traded fund, which is an ETF. That's very, very clear. So Santosh, next question to you. Are these passive funds or ETFs, are they enough to create a long-term portfolio? Because for over a very long period of time, investing has always been about picking stocks, picking sectors, picking which company will become big, right? Are these products enough to create a long-term portfolio?
Oh, absolutely, Sahil. I may come across biased given that we actually run a service on investment advice, which is powered primarily through index funds. So, but I'd like to keep the bias away and come to the question. The question is like, is it even possible to build a long-term portfolio via passives? In our opinion, it's actually far more difficult to build a long-term portfolio via actives. It's like when I'm investing from in a word go for 10 years, 15 years, 20 years, it becomes far more a high conviction bet for me as an investor or an advisor to recommend one to an investor that these are the 3 or 4 or 5 set of active funds that I'm putting my neck on and recommending to you or as an investor you're buying, and you'll continuously stay invested in them for next 10, 15, 20 years. And while it sounds very easy when you plan that, it becomes far more difficult to stay invested in that in those 4, 5, 6 funds, simply because as a human being we tend to judge the investments performance on a periodic basis. It's far more difficult to just stay invested and not bother about, not compare the performance with other associated investments, or for that matter, how my neighbors or my friends are doing with their investments. And that's where the whole problem starts, in my opinion. It's not nothing to do with active funds for that matter, but it's basically my comparison. So when I compare, I see that the funds, when I invested in them or an advisor recommended them, they were 3 or 4 or top 5 performing funds. And by the time I review them, at least half of those funds have not met or beaten the benchmark, or possibly are near category average, where the difference between the top performing and the average or lower end is far higher to for me to not act upon that underperformance. So when I look at this entire cycle over brackets of 3 to 5 years, over 15, 20 years, chances are very high that I'll end up churning my portfolio, or moving in and out of different active funds. And ultimately, what happens is there are impact costs, there are transaction costs, there are taxation which comes into picture, and my own biases about how I look at reinvestment, decisions of deploying the money by taking money out in somewhere else. So all these practical realities come into picture and actually create underperformance eventually in my portfolio. And the moment I look at passives as an alternate approach towards this, it becomes far more simple. As Vivek mentioned, you're buying the market. I may choose to buy the entire market, say Nifty 500 index funds, or I may choose to buy a large cap index fund, can be like a Nifty 50 or a Sensex. I can choose to buy a mid cap index fund or a larger mid cap index fund, like a 250 index fund that market is offers today. So if I stay invest and if I buy those funds, I know how I'm comparing against the benchmark, how I'm going to rate that performance. I may not have those emotional swings where I end up comparing with somebody else, because I know the fund is actually supposed to replicate the benchmark. So the chances of staying invested for longer in a constant way becomes far more higher in a passive fund than an active fund. The answer might change if I say that I'm taking 2 year or 3 year horizon, but a 15, 20 year horizon is far more simpler to be a successful investor by going via passive than active, is my personal opinion.
Absolutely. So I think one point that you made, and I picked it up, is if you invest in passive funds, you can save yourself from greed and envy. I'm not talking about fear. It's mostly about envy, that you don't have to compare that somebody else is making more money than me or less money than me. Eventually, you get the market return. But that point, I'll come to how to construct a portfolio using passives. But Anil, I want to throw a very simple question at you. Santosh talked about that you replicate the market, right? The portfolio gives you the market return. But when you buy stocks or when you buy active funds, you of course pay some fee, right? You pay expense, right? When it is a brokerage, or when you buy a plan, then you pay the expense of the fund. When you buy a passive fund, what kind of costs are involved? Are they too high? Are they a hurdle over a long period of time? So I want to our audience to understand what kind of costs do passives involve.
Structurally, I mean, very good point, and very often people don't go into this detail. But structurally, yes, passive funds are relatively low cost for the investor. First and foremost, the cost involves the TER of the fund, total expense ratio, which the fund is charging or the scheme is charging. Everybody over the period, anybody or everybody who has ever invested in any mutual fund or index fund or ETF, TER concept, everybody has broadly clear. Okay, that is the annual recurring fees, total expense ratio, which scheme charges on a daily basis. Very small amount is getting charged, which is getting impacting the NAV on a small way, and that is openly disclosed as the total expense ratio of the scheme. If you are investing as a passive route through index funds, then yes, this is the cost that you bear, and that's all very upfront, very visible, easy to track. If you are investing in an ETF, there is one more layer in addition to that, because when you are buying or selling the ETF, you are typically doing it on the NSE or BSE. Vivek very nicely had explained it in the opening first question. So at that point of time, depending on which broker through whom you are executing, you might end up paying some small brokerage. At that point of time, maybe there is some kind of a bid and offer spread which is getting applied. Let's say full year long, you hold it in your demat account. Some small demat fees is there. Of course, friends, nowadays is the world of digital discount broking, and very often you'll say, "Kya baat kar rahe ho saab? Mera to broking zero brokerage hai." Okay, then for you it is zero, might be, no doubt. Maybe some small cost is there, might be some frictional cost, like annual basis 200 rupees or 500 rupees of a demat charge, very small. But structurally, as a financial investment or as an advisor suggesting to your client, we need to be clear and aware of this. And that is what we call as a concept called TCO, total cost of ownership. In financial markets and in our mutual fund and index funds, it's not yet very common, very popular. We had released a note a couple of years back and we keep talking about it very often. But let me give a very small, maybe I'm simplifying over, but which everybody can relate. TCO concept. If any of you friends have recently either purchased or plan to purchase or at least evaluated any EV vehicle, electric vehicle. मान लो इलेक्ट्रिक स्कूटर आपने सोचा है या इलेक्ट्रिक कार सोचा है, डेफिनेटली द सेल्स पर्सन विल शो यू के मैडम और सर देखो ये उसका टीसीओ है. तो क्या है मैडम? टीसीओ टोटल कॉस्ट ऑफ ओनरशिप. अपफ्रंट कॉस्ट इज हाई यूजुअली, सो दे शो केस कि देखो इसका full life cycle and how much is the TCO, total cost of ownership. We need to be clear and aware of that even in our investment. So for index funds, very easy to straightforward. Just put the money, TR is there, that is your cost. For ETF, very easy, very important, but sometimes we know it, but its concept is now coined as a TCO. Important to track and be aware of that, basically.
Sure. So roughly what I gather is that if over a very long period of time, if you're replicating, let's say a Nifty or a Sensex index, let's say it delivers 10 or 12% CAGR over a 20-year period,
Right.
your passive fund will deliver slightly lower. What is the TR or TCO? That
Perfect.
maybe between 10 to 40 basis point, depending on what kind of fund you're choosing, that will be your return. So you are the
Perfect.
nearest possible return to the market is what you will get.
Yes,
right?
absolutely right. Absolutely right.
Right. So I will get back to some of these basic questions at the end, but I have a more particular question, Vivek, for you. We spoke about passives being good or not good for creating a long-term portfolio. So let's assume that there is a 35-year-old working professional who has a normal average family size and the responsibility that comes with it. What are the ingredients that this person should think about if that person wants to create a portfolio using passive funds? What are the things to think about when it comes to creating a portfolio?
Yeah, Sahil. So very interesting question. And the answer is very simple. Look here, if you are starting as an investor, if you're a beginner, as you're kind of starting your investment journey, the simplest thing to do is start with something which is the frontline index. It is essentially an index which constitutes the first 100 companies in India. Most simple thing to do. Okay. So there are indices, okay, which basically, so I will use indices and passive, in combination, so that people understand. Indice is a passive only, okay.
Right.
So there are indices which basically will help you to buy the first 100 companies. So let's say Nifty 100 example, okay. Or you may say, I want to buy Nifty 50 and next 50 separately, okay.
Right.
But what you are doing essentially is that you are buying the first 100 companies. That's the simplest thing to do to start with. And what we call that as a core portfolio. Okay. Because as you understand, the first 100 companies give you representation about the India market broadly.
Right.
You are kind of there in the India market. Okay. If you are a 35-year-old, you start with a core portfolio, which is the first 100 companies. You either buy a Nifty 100 or a Nifty 50 and a next 50. Next 50 is exactly the next 50 companies after the first 50 companies. As simple as that. If you want to take a bit of more risk, and because you are 35, and assuming that you have a kind of a long runway ahead of you, and you want to take a bit of a risk, you can actually go to something which is the 250, right? So in 250, what happens? The first 100 gets covered, and the next 150, which is the mid capitalization kind of stocks, start getting covered into that. So you are kind of increasing your scope or the universe, what we call, from the first 100 to the next 150. Okay. So you may also go in for 150 mid cap index, or you may choose to go with a 250 kind of an index. Okay. So for you at a 35-year-old, you need simply a strategy to start entering into the market, taking a passive position, buying the first 50, next 50, and the 150 after that. That should give you a nice coverage of and a nice flavor into the overall India market. Okay.
Sure.
Beyond that, there is another, 250 stocks which you can buy, which then gets into kind of a small cap segment, which are more riskier than the first 250 which I told you, right? So I think very important, you as an investor, is please do your risk profile. You will know your risk appetite, and based on that, even if you are a 35-year-old, decide your asset allocation based on that. And out of your asset allocation, you will get an answer of how much equity you want to be. And I've given you an answer of how much equity you buy and in what form and shape.
Right. Understood. Santosh, coming to you. So we've till now, discussed passive in the vein of equity funds, right? But when it comes to passive, it can track anything, right? It can track price of gold, it can track a debt index or anything. So one question to you is, how important is asset allocation within the passive framework? Are there enough products to do it? Is it doable when you use only passives? Because I think, as you know, that 60-40, 70-30, these kind of portfolio has been used globally forever. Are passives enough to do it? And if one were to do it, how to go about it?
Yeah, so I guess if the question was asked about 3 years ago, the answer may have been different, Sahil, because while theoretically it is always possible to construct a portfolio which is diversified across different market cap segments, as well as asset classes like debt and gold, as well beyond equity. But it was not practically possible because unavailability of the products themselves 3 years ago. But I think over last 3 years, we have seen so much innovation in the space where we have passives across multiple types of portfolio construction methodologies. It can be size as a factor, the way we were talking about, where I can construct a kind of passive based on top 50 companies, top 100 companies, top 250 companies, 500 companies, different sectoral indices, or for that matter, even go a bit more into smart beta kind of concepts like equal weight or momentum, alpha, low vol, value, growth, quality. So the innovation is so high today, not just across equity, but also on debt side, where we have liquid index funds in that sense, like a liquid one day overnight ETF. There are index funds on debt side, where we have a 5-year GSEC index fund, or a composition of state development loans and government bonds, or foreign target maturity funds, which are broadly tracking highly rated papers across PSUs and corporates. So it has become easier to really stay passive across asset classes as well in today's times, and one can actually create a portfolio which can kind of by combining different market cap segments or asset allocation for that matter, one can overcome the biggest disadvantage or rather perceived disadvantage of passive, which is losing the alpha.
Right.
So the answer has changed today because of the availability of products. While the awareness or the understanding of these things may be a bit complex for a layman investor today, but I think if one has an access to an advisor, or one is quite motivated to really understand the concepts behind all these factors, it is far easier to create a portfolio for long term, where somebody can stay invested with high conviction over 10, 15, 20 years, and just have a periodic rebalancing across asset classes taken care of over a periodicity which can be set by the customer or investor, or based on market conditions. It is quite possible to construct a portfolio today.
Sure. Santosh, I'll ask a follow-up question to you because you use the term alpha. And so for the viewers, let me explain what alpha is. That if you make excess returns over the benchmark, for example, if you are choosing Nifty 50 as a benchmark and it delivers, let's say, 12%, and another portfolio delivers 14%, that portfolio has delivered a 2% alpha. So excess returns that you make over and above the benchmark is your alpha, right? And Santosh, more often than not, there are complaints that when you do passives, you lose alpha, right? You lose even the possibility of making excess returns. So one question is, how important is that? Is there any other element that we should be worried about than thinking about alpha? And is it possible to earn alpha in passives?
So, if one were to just stick to one set of class of funds, of course, there is no way that you can earn the excess returns over the benchmark because the fund is just replicating the benchmark itself. But if if one goes beyond a class of funds and says that I want to create wealth over long term, devoid of human bias, and stay focused on maybe data valuations, or for that matter, keep it simple on terms of containing risk in the portfolio, where I can implement a 70-30 strategy, as you talked about, a 60-40, maybe 80-20 for that matter, wherein how this 80 in equity gets invested is decided across different kind of funds, and how the 20 gets invested again is decided by different kind of funds. So one is actually willing to put that effort to create a portfolio based on market conditions and go beyond the size as a factor. So the simple passive funds like Nifty 50 and Nifty Next 50 is nothing but a size is a factor in my opinion. So if I want to go beyond size as a factor and say that I want to understand how I can construct a portfolio of this 80 into equity, and say that I look into valuations into account and say when markets are highly valued, I would stick to value as a factor, or for that matter, a low volatility as a factor. So low volatility means that it's a kind of index fund or a passive fund or a factor fund, which basically invests in stocks which actually don't tend to be very highly volatile. The ups and down movement in the prices of the stocks underlying that index actually exhibit pretty stable behavior in terms of returns. So if I were to kind of go deeper and say that I want to invest based on valuations, I can look to allocate most of my portfolio in that equity as an asset class towards low volatility funds or index fund when markets are high, and when markets are cheaper and there is a correction in the marketplace, I might go towards alpha quality or momentum in that fashion. And if I do that in a disciplined way, theoretically you can generate far bigger alpha than the broader market or a Nifty 50 index as well. A condition that you're able to do this within a disciplined manner. And unfortunately, that is not very easy to do that unless you really put a system in place or some kind of advisory philosophy in place for your own self. But if you do that, in my opinion, it is pretty much possible to generate excess returns, which is far higher than just getting satisfied with Nifty. But again, I would not say this for greed, but I would rather say that there are ways to generate better returns. And if one is wanting to put that extra effort, one should do that.
Sure. So I heard two different type of terms, Santosh, from you: value, vol, growth, size, right? What we call factors. And the other set of terms that I heard is, how do you look at data? How do you do asset allocation? How do you look at valuations? So Anil, I'll come to you on the factors, but before that, I want to ask Vivek the other question on allocation, where Santosh mentioned the role of advisory, right? And you come from a very strong background of advising for a very long period of time. So one question to you is that when people create their portfolio, what is the role of an advisor? How crucial is that advice to create that portfolio and to last that long? What Santosh spoke about, those changes and allocation changes that you have to do. So I want to, ask you about the role of an advisor in creating such a portfolio and sustaining it over the lifetime.
Yeah, very interesting question, Sahil. So we often say we don't manage wealth, we manage behaviors. Okay. And managing wealth with managing behaviors, that combination is very important.
Right.
Okay. And then the wealth gets managed in the correct way. Otherwise, it will kind of swing in different ways and drift in different ways, based on the market conditions. So advisor as such has to play a very important role, because it's like, your sounding board, number one, from an expert who gives you an expert opinion. Okay. It's not a general opinion where you go to a chemist shop and pick up products. In what combination you consume the product depends on what situation your health is. Okay. And therefore, I think from an expert standpoint, it is very important to understand the psychology of the investor, the temperament of the investor, the behavior of the investor, and the tolerance of the investor. And investors come in various shape and forms. They have a tolerance. They may come with different capacities. My risk taking capacity could be different. My willingness to take risk could be different. So advisor, number one, controlling the behaviors and making sure that the behavior is well managed, wealth to create ho jayega. Number one. Number two, getting into technicals, asset allocation, putting your asset allocation in place. If you have a completely 100% equity portfolio, I can tell you it's a car without brakes. What
Right.
what can happen? I don't have to explain all of you. So we need to have brakes for the car, right? And therefore, your journey has to be such that you will reach the destination. Okay. So therefore, that asset allocation will work as a car with a brake at some point of time. If I give you a very simple analogy, the selection of the indices, in what a manner you select, the portfolio rebalancing at different points, because you'll have to remember that markets are not in our control. So therefore, the portfolio will keep drifting. So how we have to make sure that the course correction happens? I want to move from Mumbai to Delhi. So I have a certain degree at which I fly my aircraft. If I move 5 degrees, I will reach Lucknow.
Right.
If I move another 5 degree, I may move to Calcutta. So the point is that the drifting will happen. I don't want to reach Kolkata, right? I want to reach Delhi. So I have to course correct at different points of time. Tax efficiency in the overall scheme of things. Planning, monitoring, and reviewing, all these aspects are, when you package it together, an advisor actually brings it on the table. Now, these are all abstract. You can't touch, but you can feel when things
Right.
are happening, right? You can feel. And that is the advisor which plays a very significant role when in the investor's journey as such. So I think in my career of 20 years, I have seen that these are 5, 6 elements which continuously keep doing their job, whatever needs to be done.
Sure. Thanks, Vivek, for that answer. Anil, the other side, where Santosh spoke about value, low vol, growth, right? Some of these, what we, in financial terms, what we call factors. And there is this whole bunch of smart beta funds, right? And they have come up recently, they have become much larger. What are these smart beta funds? How relevant are they? And if you can give an example.
Okay, well, I mean, I'll try to answer in small parts. So structurally, yes, in very simple layman term, what we call as factor is nothing but drivers of risk and return of any security or any index explained by breaking it down. Or I'll put it in other way. Very recently, depends on which part of the country you're in, but let's say if you're in Mumbai or now there's in some many other cities, there is a marathon going on, or going to come, or Bombay marathon just got over. When you're preparing for a marathon, you've gone to a dietitian and they have said, okay, for this next 3 months or 2 months, you have to consume X amount of carbohydrates, Y amount of proteins, and so much amount of fat to make sure that your practice in run up to the marathon remains proper, right? So somewhat similar, like how Santosh mentioned, or like, and Vivek explained very nicely that how an advisor is needed. You can't, I mean, just go and buy something off the shelf. You need to think that, okay, this is now that advisor or the model or the tools have indicated to you that these are the elements of your drivers of risk and return, which includes, let's say, momentum, let's say volatility, let's say size or growth or value, and currently we feel that in preparation of the next, let's say XYZ event, or in line with your this particular financial goal for which you're investing, you should have more of this particular factor in your portfolio. And for that, then certain factor funds you can pick and choose and invest into your portfolio. So it's more easy to understand when you try to distill it this way, that how each and every food item can be broken down into specific components, like that each and every stock or asset class or index can be broken down into different elements which are the drivers of the risk and return of that particular security. So there are various examples, Sahil, and today, like you said very rightly, this has been growing very fast and very recently, like value, growth, momentum. Then there are multi-factors, like what we have one particular thing called alpha, quality, and low volatility. I feel sometimes the simplest form also works well. So for example, when we did we wanted to do simplest form of smart beta, at that time we were seeing some of the global markets. The research was done by a large global company, that where the investors of that market, which factor fund they are seeing very big interest in the next coming couple of years. So the least popular that time was equal weight. So we thought that, okay, this is a possibly most simplest. So our first fund which we did was equal weight strategy. So sometimes if to the end investor it is easy to explain that, okay, this is in 2 lines, this is the concept, that makes it more powerful, that makes it more beneficial. In some form or fashion, what we buy overall market, we call it beta. When you try to buy something different from the market with the intention to try and either outperform, means give a little bit higher return, or try to reduce the risk, that is nothing but calling smart beta. So that's how we try to package it for the investor from our side, basically.
So basically, when you filter out specific traits that you want in your portfolio, you use smart beta funds to create a more robust portfolio. That is what I gather.
Perfect. Exactly. Yeah.
So all the participants can ask questions, which I will pose to all our panelists today. So there is a question button on your screen. You can press there and ask questions. I will take it up. I already have a few questions which I will ask all of you coming from the audience. So one of the question, which is one of the most important ones often asked, is when you look at an index fund, Santosh, this is to you. What are the key traits or ingredients that you should watch? What should I look forward to when I select an index fund? You're on mute. Yeah.
I think a lot of literature has been published, available on this, and maybe it is something which end user may not be able to verify or understand. But for the sake of it, let me just cover them. The first, when you're investing in index fund, the most important driver of your performance, or driver of the replicating the performance of index, is the expense ratio. So the higher the expense ratio, the bigger the gap the investor would actually see in the returns of the benchmark that the index is tracking and the index fund itself. So always try to see if you are able to buy an index fund which is lowest cost of expense, or the expense ratio there. And then another complicated term, which is tracking error, basically what is the difference over a long period of time between the returns of the index and the returns of the index fund. But I would like to. I typically have seen this a lot, where most of the fund houses across the country are very competitive today, and there is no and replicating index is not very big rocket science. If the fund is able to attract AUM, every fund would try to minimize the returns a gap that their fund is seeing against a benchmark. So the one simple hack can be that if the fund has enough AUM, if the fund is somebody you believe that you have an allegiance toward a brand, and has an expense ratio which you believe is competent in the marketplace, you should simplify the decision and go and stick along with that instead of overcomplicating the process of selecting the fund itself. I think one of the biggest advantages of index fund is it removes the indecision or time taken to choose where should I invest my money. And if the moment you try to apply too much of science behind selecting an index fund, you possibly lose the first advantage of making a decision quickly, of going against passive, active, and choosing index fund. So keep it simple. Look at expense ratio, look at the AUM, look at the fund house that you have a strong disposition towards, and you can go and invest in that.
Sure. One additional question, Vivek, to you is which has come from the audience. People who've been, investing in passive funds. One question is for them specifically: is there a way to select smart beta funds? Right. The specific question comes with a rider saying that how do I know when to buy a value-based smart beta fund versus a low vol or a growth-based fund? Is there a method to madness?
Very interesting question. So I think the way I would choose to answer is in two ways. Okay. One is about your own preference about, what is your own preference about something? Okay. So for instance, if you don't want volatility as an investor, okay, then you typically look at something which is low vol, which is low volatility. Okay. Something which is value. Okay. Something which is dividend based. So you don't see volatility into those, and those are kind of stable. Okay. If you want risk into the portfolio, you are looking into momentum typically, or you are looking into size. Okay. You are looking into growth as a factor. So let me give a very simple example. And I like to give example of a food item, which is pani puri.
Mm-hmm.
When you go and ask a bhaiya, bhai, aap pani puri dena mujhe, right? They will give you a general pani puri. The general pani puri is your Nifty 50 next 50. Very simple, basically. Now, आप जाके बोलोगे मुझे थोड़ा तीखा देना, which means higher volatility. Okay. कभी कोई आके बोलेगा मुझे थोड़ा मीठा चाहिए, correct? Which is low volatility. Okay. So if you look from that angle, you understand that you have a general preference, you go towards an index. If you have a special preference towards something other than general, you either go this way or the other way around. Okay. In which, let's say and therefore, thika meaning volatility, meetha matlab less volatility. Let us put it that way. So that is how you choose. Okay. So as an investor, you have a temperament. My suggestion to you is that don't follow the other person, because you don't know what other person is doing and why he's doing and what profile he has and what temperament he has. Okay. This also depends on your life stage. It also depends on the goals which you are going to fulfill because of this investing. Okay. So I think if you bring this together and look at it and then say, okay, this is something which, I'm going to feel comfortable about it. Remember, ultimately, you need to be comfortable about something you buy. Okay, if I'm going to feel discomfort about it, then there is no point buying. If I'm wearing this shirt and if I don't feel comfortable, I don't think I'll be able, again wear this shirt, right? So I think the question is not about the quality of the shirt. The question is about how comfortable I feel wearing this shirt. So as an investor, remember, you are the only person who will decide how comfortable or uncomfortable you are. Okay. All the other things are more jargon. They may look very fancy, but ultimately investing is very simple. First, ask yourself, first know yourself better. Then you get into the market and choose what you want.
Sure. Thank you, Vivek, for that. Anil, one question to you, because next question reminds me of one of the articles that you wrote, जिसका title था कितना देती है, and how big it is. So the question is the generic ones asking that is AUM a matter of concern when it comes to passive funds or index fund, specifically mid and small cap fund. Should we look at the size of the passive fund?
Sure, thanks. That reminds me of, basically there are 2-3 things which I keep writing. One is kitna deti hai is slightly different. It is about a tracking error.
Right.
But kitna bada hai, that is the question.
Kitna bada hai. Yes.
So very often we keep getting asked this question, and many of my friends, colleagues on the sales team and marketing team, they always face this question ke, madam or sir, aapka fund kitna bada hai? So I say, see, and a little bit divergence in some form to what Santosh just explained, and I appreciate and respect that view as well. My point is that in a passive fund, especially let's say when you are looking to select which ETF I should buy, very often this question comes up in more so in ETFs and also index funds, of course. The underlying security or the underlying investment universe becomes very crucial. So as long as, and Sahil, as you mentioned, in mid and small cap specifically, people are saying, what is the size of your fund? My point is, if we are able to get a handle on the underlying investment universe or the underlying portfolio, and that has to be LLT, large, liquid, and transparent. So as long as my underlying investment is LLT, me as a fund manager, when I get any fresh money from the client, I can in a simple way, deploy it. And you as an investor can also see that, because underlying is large, yes, it is liquid, yes, and it is transparent also. So let's say, for example, I get large fund today, 100 crore money, hypothetically speaking, in one of our, I won't take the name of the scheme because, but one of our, let's say, mid-cap related strategy. Now, in that, what happens that structurally those stocks, though it is technically mid-cap, but they are known and upfront clarified on a daily basis on, let's say, my website or on a public domain. And you as an investor or you as an advisor can also see it on your screen at that point of time. You are seeing the current levels or valuation at which the price at which those stocks are trading. You are seeing the liquidity. You are seeing, okay, fine, now my order is getting executed. Broadly speaking, this is the level at which it is got executed. So that gives a very high level of comfort to even the investor and even to me, because I don't at that point of time have to take any human bias or human judgment कि ये अभी ले नहीं ले कितना कम करेंगे थोड़ा बहुत कल परसों ले लेंगे आज वॉल्यूम नहीं दिख रहा है. It's not like that. So the importance of the underlying investment is more relevant than the wrapper or the fund size. Like अपन बोलते हैं ना कि हाँ there is a color pencil and the lead inside the pencil in the shade of that कलर पेंसिल कि हाँ भाई मुझे ये वाला रेड चाहिए. संतोष सर आपका रेड जैकेट बहुत जम गया मुझे, रेड स्वेटर बहुत मजा अच्छा लग रहा है, बट वो शेड मेरे को इंपॉर्टेंट है. Then the size of that pencil, let a little big or small, that shade will come out exactly the same basically which I want. So LLD underline should be large, liquid, transparent. तो फिर कितना बड़ा है, how big is the fund size, that question should ideally become irrelevant. Other aspects, yes, perfectly agree what Santosh mentioned. You should look at the historical track record of the tracking error of the fund and tracking difference. You should look at whether that particular fund house you are investing with, how serious they are in this business, whether they have set up a dedicated investment team to manage your investments in a focused way, ease of convenience of doing the trade, whether they have a small branch near you, how good is the digital platform to enter or exit, buy, sell. Those things are very crucial, I feel, rather than the size of the fund.
Sure. Thank you, Anil, for that. I'll come to a behavioral question to you, Santosh. But before that, I just wanted to, ask Vivek, going by the same, personal profile of a 35-year-old, if you were to look at a cross-asset portfolio, mix of equity, debt, gold, etc., and if the person is a beginner, what should a rough portfolio look like? I know it's a very personal question. It will depend on a lot of, factors for that person who's investing. But just a caricature of a portfolio, what should people think when if you can give broad ranges also, it will be very useful.
Yeah, so I'm assuming that a 35-year-old guy will have a very normalized risk tolerance, okay? And therefore, I'm saying that he would have typically about 30% in debt and 70% in equity, broadly, okay? So if we say I have $100 to spare, I would have 70 into equity and 30 into debt. Now, out of 70, what I would essentially do is, as I said, I will start with something which is core. So I would buy a Nifty 50, which is 15% of that 70 rupees. Next 50, which is another 20%. So that makes up about 35%. Then I go to large and mid cap 250, which is about 20%. Okay, so that makes another 55% for me. Then I go to Nifty mid cap 150. Okay, where I want more risk. Okay, a thoda thika type. Okay, so then I go and park another 15% there. And now I want a little bit more flavor, which can help me to beat. So therefore, I choose two factors. One is low volatility, okay, which is Nifty 100, low vol 30, what is called as park 15% there, and a Nifty 200 momentum 30, where I park 15% there, okay. So that gives a combination to me of a very good, decent diversification where, I enjoy the passive I enjoy passive with factors, which are two factors, which is low vol and momentum, which are slightly different in nature. और उसका taste अलग होगा, right? In terms of how you mix it. And then on the debt side, you look at something which is typically, a kind of a BSE India, the S&P BSE India bond index, which is 15%, and another 15%, which is a government bond index. So what happens is that you're kind of, diversifying across the allocations, which is equity and debt. See, I'm not bringing in the commodity at this point of time, unless you have a preference towards precious metal. And you say,
Right.
okay, I want gold. I
Right.
need to have gold. And of course, you can definitely have 5% of precious metal, which is gold. Okay. Or an industrial metal like silver, for instance. Okay. Provided you want to add that into, okay. So those are like sprinkle, you sprinkle something which adds on the taste very differently. But otherwise, I think if you are a beginner, okay, you can simply start with an equity debt, start looking at something which I just mentioned about, which will give you a decent taste and a flavor in terms of what you're consuming.
Sure. Thank you. Santosh, maybe you also want to attempt that, creating a portfolio. But one question in addition to that is that when I looked at data, if you add a Nifty 50 and a gold in equal weight over a long period of time, you end up having returns even greater than Nifty, right? Because of the uncorrelated behavior of these two assets. So one follow-up question to that thought is, uh, how good or bad an idea it is to go in international markets using passive funds, and do they or should they form part of your overall portfolio when you create a portfolio? So a portfolio attempt from you plus this question.
So I'll just try to go with considering a portfolio because that's the flow of the discussion right now. So,
Sure.
at ETMoney, we believe that, of course, we should look at funds risk profiling. We call it Mr. Personality. We look at one's time horizon for investments and the importance of goal. And third being the market conditions. I think we've come to realize that if you don't keep market conditions in mind at the time of investment, and if the markets are maybe overvalued at certain sense or possibly towards higher end of valuation range, then the initial experience, even if a 35-year-old or 30-year-old going bad, will have a strong negative connotation towards his or her ability to stay invested for long term. So at no point of time we ignore the market dynamics or valuations before considering a portfolio. So if you were to look at today, one philosophy we follow is try to avoid overlap. So one of the biggest advantage of owning passive funds is you can avoid portfolio overlap. Today, if you were to invest in an actively managed fund and consider a portfolio of a large cap, mid cap, small cap, or a flexi cap and a mid cap kind of approach, you would typically find a large part of the portfolio is overlapped. Like 30 to 40% of stocks will be actually ending up being common. Whereas investors may not realize that, but the fact of life is you're actually paying two different fund managers for owning same kind of stocks. So the one big advantage passives have is I can choose to construct a portfolio where I avoid portfolio overlap completely. So at ETMoney, when we construct four portfolios of people, we avoid factors. We keep it simple towards size-based, portfolios, size-based index funds, Nifty 50, Next 50, mid and small cap, as Vivek was talking about. And if we were to do that today, we would going to put more money towards Nifty. What allocation can be a bit difficult to answer at this stage, but we put more towards Nifty 50 and Next 50, less towards small cap, somewhere in between towards mid cap, and would not avoid gold and debt at this stage, given the market situations. So again, just for the kind of sake of answering the question in terms of allocation, I would put about 70 towards equity, 20 towards debt, and 10 towards gold. For 70 of equity, I would possibly keep towards 30% toward Nifty, 20% toward Nifty Next 50, 15% towards mid cap, and 5% towards small cap, as 70% locking towards equity. We like to keep it simple towards debt, owning a a 10-year GSEC or a 5-year GSEC index fund can do far better and simpler for you. We have fans towards, we have allegiance towards, a 5-year GSEC index fund available in the market today. Very limited volatility compared to the 10-year GSEC, and almost similar performance if one looks at long-term performance of this index in that sense. And tend towards gold ETF / index fund can do healthy, can be more of a common portfolio as well for a lot of people across market conditions. And if we were to do towards factor-based investing, which is a different approach altogether, I would keep towards quality and a low volatility today, given the market situation today. And avoid momentum or alpha-based investment approach today. On the second aspect talked about, which is taking international allocation to from passives, I think it's a great time. It's a great thing to happen today that we actually have access to an S&P 500 index fund today. I think if I were to remember correctly, S&P 500 ETF is actually the largest traded security on the across the world today on a daily basis. And one of the best ways to actually invest, not just in the US, but across the world, simply because almost 40% of the revenues of the underlying stocks in S&P 500 have revenues coming from outside of US. So you actually not just diversifying from currency of India and owning a US exposure, but you also, by buying a US exposure, you're buying an Asia Pacific, Europe, and other revenue sources that S&P 500 companies have. So I think S&P 500 index fund is one of the great ways to take international exposure today. It gives you not just US, also gives you Europe and Asia Pacific to some extent. We like to avoid thematics. So Nasdaq 100, which is possibly the favorite of most of the Gen Z today, in my opinion, is too thematic, too tech heavy, and not really something which we believe can suit a long-term investment. If it was short-term call, the answer may have been different. But if you are building a portfolio for 10, 15 years, it's far better to be diversified than to be thematic. So that's the way to go about it, in my opinion.
Sure. Anil, slightly tough question for you is one from the audience, that when should I know that the index strategy is not working anymore? And if I would want to put my own tadka in that, how would I know that I'm not sitting in a China or a Japan for a very long period of time and I'm buying the market, but it does nothing over a very long period of time? In that situation, what should an investor do? Is there a strategy or change of how you invest that you should do?
I think very difficult question you mentioned, but answer is very simple. And I think Vivek made it very clear that structurally, friends, that is the role of a good, trusted financial advisor, that they will keep guiding you, keep giving you the clarity or some kind of a input that yes, whether this type of approach is fine or not. Yes, whether the market not going anywhere, but at that point of time, how your underlying is expected to change. And if at that point of time, your certain life goals are coming in a different manner, they will recommend you will need to change. But if it is not there, then maybe not. For example, 2000 and I would say 21, I think so, last market peak, and then for about 20 months, with almost about 2 years, broader markets, our India markets, Nifty 50 didn't do much anything. Like, it kept a little bit, went up, then again went down, and range bound, and again came to when we reached back to around 19,000 levels, 18,500, 19,000 levels. Again, now in that 2 years, technically, one can say was I was investing and, my fund didn't do much for me. But at that point of time, somebody like a Vivek or somebody whoever is your trusted financial partner or a financial advisor will give some comfort that, okay, maybe because of this XYZ reason, right now it is looking like it, but maybe the underlying instruments that you have, those, let's say stocks, let's say taking Nifty 50 as an example, we were seeing that, okay, the EPS or the earnings per share of the Nifty 50 was growing very well, basically, during that period also. So Nifty 50 earnings grew approximately about 30% during that period, whereby Nifty 50 delivered almost flattish return. So if you are on your own just seeing, this is not moving, let me get out and move somewhere else, I'm not enjoying this returns profile. But Vivek will, or somebody, your trusted advisor will that time say, sir or madam, don't worry, because right now your particular life goal is yet another 10 years away. this is in a structurally comfortable position because the underlyings are doing good. But let's say if you have some life goals, then they will be able to better guide you. They become like your family doctor. They know how you and your entire family thinks and reacts in different risk situations. They know when there is going to be a family wedding, or when the young somebody in the family is going to go for overseas studies, and when you need that big chunk of money. So that becomes very crucial. And I feel that is the answer. Otherwise, there is no right answer. You will by and large end up going wrong. Because if with this recent most seen example, if you would have tried to take out money of the funds, then you would have later on sitting today, just like 3 months, 4 months later, you will figure, boss, that was a blunder I made at 17,000 Nifty 50, for example. If I removed money by waiting after 2 years and then now feeling, boss, now to see where it has gone 22,000. Just example I'm saying.
Right.
Yeah.
Sure.
Sahil,
Yes,
Sahil,
please.
I just want to add what
Please.
Anil
Please.
said.
Yes. Sorry, I took your example a lot, and I tried to fix it in.
Yeah. So I think one of the theory is known as a bus stop theory. Okay, in investing. So when you are standing on a bus stop waiting for a bus, okay, and the bus doesn't come for a long time, huh? Actually statistically the probability of the bus coming is much larger, okay, much higher in that sense, because you have been waiting, you were expecting it to come in 20 minutes, but actually 45 minutes ho gaya, bus nahi aayi, and you are kind of hitting on the bus stop. Okay, the statistically the probability is very high that the bus is going to come. Now if you are very jittery and you say, okay, let me take a cab and go, and when you sit in the cab, पीछे आप देखते हो तो बस आ गई, right? So the point I'm making is that I think the patience piece is very important. So simply the bus stop theory is essentially, if the bus is not come for 40 minutes, unless it's a curfew in the city, okay, otherwise the bus is going to come.
Right.
So I think those things are very important. I'm just adding to what Anil said.
Perfect. No, completely.
Yeah. So I think again, I think investor behavior is very important here.
Absolutely. So I think we have sort of reached closer to the end of our conversation today.
Santosh is trying to say some last point. Santosh,
please go ahead.
Just to add to Vivek, I guess I remember when I was in Bombay, I used to have a bus stop theory myself, and if you have waited for half an hour for the bus, there is no way you will take a rickshaw ride nor a taxi ride to go to college. So just remember that piece. But coming to the answer there is that it's like one of the ways to avoid that problem where you get stuck in an asset which is not moving is a compromise the first 10% upside. Wait for the trend to change. So at ETMoney we apply, we try to combine two approaches here. There's no science, scientific way to say that it is working or not working, except looking at data and saying that it works. It's combined fundamental and some kind of momentum / technical into it, where if you are willing to let go of the last 10% upside and book your gains, get out of market, or be willing to lose first 10% upside and then enter the market, I think the wealth you can create is far better. While it goes against the theory of saying that stay invested, give time to the market, you'll make money. I think that there's nothing which beats that theory, but it is far more difficult to practice that as an investor, given how dynamic our lives are and how markets are. It's like when I invest, say 10 lakh rupees in the marketplace today, and I see a 10%, 15% correction, that is just 1.5 lakh rupees in absolute terms. But when I put 2 crore rupees in the market and I see a 15% correction, exactly same, but I lose 30 lakh rupees in the correction, my reaction is going to be very different compared to what it was at 10 lakh rupees. So I think, if you don't marry the absolute numbers with the risk profiling, then you may end up going wrong. Hence, looking at market conditions, looking at market trends can give a far more advantage to you as an investor or an advisor when looks at that, because the fact of life is human beings are going to react in a very different way. What you speak and what you do will not be same forever unless you have a system or a framework in place to advise / practice investments on your own. You would not be able to stay put all the time. So that's just 2 bits from my side. Look at the trend to change before you go all guns blazing.
So let me add one solution from my end. I think it's a simple old SIP, right? That if you were to just follow a systematically disciplined approach over a very long period of time, you will accept average prices, average valuations, and you will end up doing much better over a very long period of time, and you will stay invested. That is also the simple, plain old, humble SIP. It does wonders for you over a longer period of time. And just to summarize our discussion today, passives are here to stay. What Anil said, they are growing in size with momentum. I think the size is coming. There is investor preference. And one of the leading reasons is that they come in all shapes and sizes. You get the choice that you want. They come with low cost, right? And you don't have to pay too much to own them. And you get exposure where you want, which Santosh made a beautiful point that you can avoid overlaps. You can choose where you want to invest and you can stay invested for a very long period of time. So the conclusion is that this asset class or this way of investing, which is passive, is here to stay. And participants who invest through passives are probably going to gain a lot more in the future. So with this, I will thank all my participants here. Thank you, Santosh. Thank you, Vivek. Thank you, Anil, for your time and all the wonderful insights that all of you gave. And looking forward to have a conversation with you again. Thank you to all the viewers for your time and watching this. Thanks.
Thank you, Sahil.
Thank you
All
very
the
much.
best. Thank you.
Thank
Cheers.
you. Take care. Good.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.